Okay, let's work some problems together from chapter 5. I'm looking at the computational exercises. Very back of chapter 5, if you have your book, it starts on page 5-28. If you're looking at your ebook, just make sure you select the computational exercises and you will see them. I'm going to work through all of them. There's quite a few. The first one, question 15, it says at the beginning of the year, Marna Corporation is a calendar year taxpayer, has E&P of 32,000. The corporation generates no additional E&P during the year. On December 31, the corporation distributes 50,000 to its sole shareholder, Abby, whose basis is 10,000. How is the distribution treated as tax purposes? So a lot of the problems this week are more kind of just descriptive. There's a few computations, and I kind of built a few in the Excel file that you can see in my screen right there. But for this one, it's a really simple computation. In fact, I should just go down to a blank portion of the file here to work through it. So remember what some of the rules are. So you can recall some of the very first slides from the Chapter 5 PowerPoint mention that. And it's basically to the extent that a distribution is made from corporate earnings and profits, the E&P, the shareholder is deemed to have received a dividend. Distributions not treated as dividends because of insufficient E&P are typically non-taxable because they're return on capital up to the shareholder's basis. Anything above basis then is a capital gain and taxed as a capital gain. So Abby in this example, looking at the problem, remember their current E&P is 32,000. So Abby will receive 32,000 as a dividend. Okay, so I'm just going to put a dividend right here. Then from there, there's remaining 18,000. So the total amount paid to her, the distribution was 50, minus the 32. That's a dividend. That's 18,000. That 18,000 then reduces her basis down to 0. Remember that her basis is 10,000. So what's left over then is of that 18,000, 10,000. Let me just do my commas here just so it's a little easier to follow numbers. Okay, so 32,000 dividend. Extra, what's above the dividend, 50,000 minus 32 is 18. Of that 18, the non-taxable amount, the return on capital gain is 10,000, which happens to be her basis. Okay, and what's left over is 8,000. Okay, and that's capital gain. Okay, so she'd pay tax on the dividend of 32. She paid tax on a capital gain of 8. Whatever the rates are for her, she'd pay the same rate for both. Okay, that was question 15. Take a look at 16, and 16 is what I've got this schedule here for. On January 1 of the current year, Rondell Corp has accumulated E&P of 13. Current E&P from the year is 84, earned evenly throughout the year. Elizabeth and Jonathan, so two people, are the sole equal shareholders of Rondell from January 1 to April 30th. What's challenging, though, is on May 1, Elizabeth sells her stock to Marshall. So Elizabeth and Jonathan, January to April 30. On May 1, Elizabeth sells to Marshall. Rondell makes 2 distributions to shareholders during the year, a total of 42,000, 21,000 each to Elizabeth and Jonathan on April 30th, and then a total of 58,000, 29,000 each to Jonathan and Marshall on December 31. So the question is determine the allocation of the distributions by completing the table below, this table right here, and assume the shareholders have sufficient basis in their stock for any amount that is treated as return of capital. Okay, so you got the 2 distributions, 42,000 on April 30, 58,000 on December 31. So let's go ahead and do the calculation for this one, and keep in mind that we have current E&P for the year is 84,000. Okay, so current E&P is 84,000. I'm just going to type that number in. And what we do is we take that number, that 84,000, I'm going to maybe make this just a little bit bigger to make sure you can see it, is that 84,000, I'm going to multiply that by the sum of the two distributions, 42,000 plus 58,000. Okay, the two distributions right here. These are the two distributions. And then I have to divide that. I didn't do that quite right. So I'm going to take 42,000 divided by the sum of both of these. Let me get all my parentheses just right here. Okay, so I'm taking 42,000 divided by the sum of 42 plus 58. Okay, hit enter on that. And I didn't do it right. I had to type in an equals or a plus sign over here. And then that should work. 35,280. Okay, so there's my formula right there. And I kind of do the same thing over here. Well, actually, below that, I'm going to do the same thing. So that was 35,280. Then over here, of that amount, basically, I just take what's left. I take the 42,000, and I subtract the 35,280. Okay, and the sum, of course, of those two then becomes 42,000. So return on capital is a big zero. Then down here for the December 31 distribution, I kind of do the same thing. I start out with the 84,000. The sum of those two is 80. I'm sorry, not the sum of those two. 84,000 is the current E&P. Let me get that right. Okay, so 84,000, just like before. This started out with 84,000. And this time I'm just going to take the same formula and copy it, and then we're just going to make one little change to it. That'll be easier. Okay, so I'm going to just hit enter on that. Got the same number for now, but this time I'm just going to take this, instead of this being 42, I'll have it be the 58. And that'll work. Okay, so that's 48,720. The sum of these two is now my 84. So I should just add that up so you see it. Okay, so there's my 84. That's my original, that's my E&P. Okay, then I do the additional part over here. And I take the 58,000. Okay, this from out here. I subtract the 48,720. I get 9,280. Okay. But then I have to worry about my remaining accumulated E&P. So with this in mind, basically the question mentions they have accumulated E&P of 13,000 prior. So basically that's what they have in previous years is 13,000. And we just gave away the current year. So this is the current year, and the prior year is 13. Now the sum of these two numbers is 16. Okay, so that's the issue. So I'm going to back off the difference between 16 and 13, which is, we all know, mental math is 3,000, and back off 3,000. Okay, and then the other 3,000 that's left over is right here. That's return on capital, and that's the answer. So I'm going to add these two up just so you see it. So the 84,000 is the current E&P. 13,000 is what we had before that. So I've given that away, and I've got an extra 3,000. That is return on capital. Okay, so that's 97. This adds up to be 100. So 84 plus 13 plus 3 is the 100 that I've distributed. So 84, 13, and 3. Kind of complicated, but you have to just kind of make note of adding both left and up and down to make that work. Okay, that was question 16. Take a look at 17. For 17, it says that Rover Corp would like to transfer excess cash to its sole shareholder, Alicia, who is also an employee. Alicia is on the 24% tax bracket. Rover is on the 21% bracket because it's a corporation. Because Alicia's contribution to the business is substantial, Rover believes a $25,000 bonus in the current year's reasonable compensation and should be deductible by the corporation. So think of that bonus as just extra salary. Obviously, then Alicia receives that, pays her tax rate at 24%, and the corporation receives a deduction because it's treated kind of like compensation. However, the Rover is considering paying Alicia a dividend of the same amount, the $25,000, because the tax rate on the dividend is lower than the tax rate on compensation. Is Rover correct in believing that a dividend is a better choice? Why or why not? And as always, with tax, it kind of like is well, it depends, right? That's almost always the answer. So I'm just going to scroll down to a blank area. Let's work on this one right here. And we just have to work some math here. This is thankfully pretty simple math. And remember, what her dividend rate is. She's going to receive $25,000. Okay. The dividend rate would be 15% for her. Okay. And then at $25,000 at her ordinary income rate, it's 24. Let's just do both. Okay, let me get my decimals just right. And so let's just do some multiplication. Okay, so this is dividend, and this is bonus, and basically what her tax would be, 3,750 or 6,000. Okay, so just the math on that, and then you can kind of just do the what's left over too. So let's do her net. Okay, what's left over. So let's just call this after tax. Okay. And the difference, clearly there's a difference here. Okay, is $2,250. So she'd prefer the dividend because it puts more money in her pocket. Okay. Now the other thing to consider, though, and this is well, it depends, is who owns the company. Let's assume that it's just Alicia. Okay, so just Alicia is the owner. So remember that for Rover, if they pay her a bonus, it's tax deductible. So let's put this in the bonus column. Let's go back to my 25,000. And they pay the 21% rate. So let's kind of do the same thing. I'm going to copy some formulas here. Okay, and I'm going to copy these down. Okay, so this is Rover. This is Rover paying the bonus. Okay, so they pay it, they get the deduction, and they would save, their taxable income would come down by $5,250. Okay. Obviously, if she pays a dividend, we all know for a corporation there's no tax benefit from paying a dividend. So if the business pays her, it saves $5,250. Okay. So look at the difference then. So if Alicia is the sole owner of this corporation, you have to think of the corporation side and her side as we think about the two, right? So she's better off personally by receiving a dividend over a bonus. She's got more money in her pocket. However, the tax savings to Rover for the bonus is $5,250. So we have to compare the $5,250 savings against the extra benefit here of $2,250 for her. So in reality, we'd compare the $5,250 against the $2,250 and say that net she's best off going with a bonus because of Rover being able to get the 21% tax savings in the $25,000, which they don't get over here. So she's way better off by going with the bonus because that helps the business reduce its taxable income. So that's the answer. Now, if there were several owners, that'd be a different story. But that would be the example for Alicia, at least. So question 18 then is when a corporation distributes property other than cash to, I'm sorry, I'm reading the wrong thing. Global Corp, question 18, Global Corp. Distributed property worth $850 fair market value, $415 adjusted basis, property subject to a 230 mortgage. The shareholder will assume that mortgage. Global has ample E&P to cover the distribution. What is the amount of the shareholder dividend income? What is the shareholder's basis on the property? This goes back to some of the original rules we talked about in the slides. And thankfully, this is a really straightforward question. So the rule here is when a corporation distributes property other than cash to a shareholder, the amount distributed is measured by the fair market value of the property on the date of distribution. As with the cash distributions, the portion of property distribution covered by existing NP is still a dividend. Anything excess is return on capital. And then basically up to the basis and the capital gain after basis. Also, the amount distributed is reduced by any liabilities, which is distributed on the property. So I got to take that into account also. So as a result, so basically we have a taxable distribution of 620. So let's just do the numbers here. So the fair market value of the property was 850. I'm just going to drop the zeros. This 850. It's 850,000. And then that 850 was subject to a liability, basically a mortgage. So we're going to subtract from that the 230 mortgage, and then the net is just the sum of the two, which we all know is 620. Okay, so that is the distribution is treated as taxable dividend. So this is the taxable dividend. Okay, of 620. Okay, take a look at 19. 19, Quinlan has ample NP to cover any distributions made during the year. One distribution made to a shareholder consists of property with a basis of 150 and a fair market value of 90. What are the tax consequences of this distribution to Quinlan? So Quinlan's the corporation. So now we're kind of looking at this from the corporate side. Also keep in mind with 19, we have basis of 150 and fair market value of 90. So it's upside down. Okay, that's the way to think about it. Basis of 90, fair market value is 150. Okay, so essentially we're at a loss here of 60. We can all do the mental math there and figure out that's a $60,000 loss. So the rules here are a little bit different for the corporate side when there's a loss. Again, we have to go with the fair market value. All distributions of appreciated property generate a gain to the corporation. However, you don't recognize a loss on a distribution, which we have here. So they can't recognize the loss. So we all, everybody should see that there is a loss of 60. Okay, so type in loss there. So they can't, if they do this, they would not get a tax benefit of a $60,000 loss. So this is where, as their accountant, you would say, hey, you can still do this and get a loss, but go sell it. So basically what you would say is go sell the property, sell it for the 150. Let's see, did I get those backwards? Let's see. Oh, I got those back. I'm sorry, I got that backward. Basis is 150. Fair market value is 90. I have a loss of 60. Sorry, I got that backwards. So let's go sell it for 90. And then once we sell it for cash for 90, we get to recognize a loss that we can then use to offset taxes. Okay, so we can record a loss, and that will help us out. And then we can go ahead and give that 150 of cash to our shareholder. Okay, so that's what we should do. Okay, so that's what we should do. So let's go ahead and sell it for 90. I said 150 for cash, but sell it for 90, and then recognize the loss, get the tax benefit from the loss, and then give the 90,000 to our shareholder. Okay, so that's the answer. Sorry, I got that backwards. Take a look at question 20. This says Fargo Corp distributes property basis of 260, fair market value of 310 to a shareholder. Fargo has sufficient EMP for distributions. What are the tax consequences to Fargo? And again, kind of the same rules we've been talking about. Corporation can generate a gain for E&P when you do this, but you cannot generate a loss. This is clearly a gain, so I'll use the same little rule here. So for my basis for question 20 is 260, and my fair market value is 310. So this is actually now a gain. I should just do my math so it's positive. Okay, so this is a gain. We have a gain of 50 now. Okay, so that gain of 50 increases E&P. So E&P goes up by the 50, and then also decreases E&P by the 310 fair value. Okay, so essentially the net decrease is 210. So the net decrease is 310 minus 50 for a total of 260. Okay, the shareholder who receives that receives a dividend of 310, assuming there's sufficient E&P. Okay, the dividend of 310. Okay, take a look at question 21. Deerwood Corp lends its principal shareholder Lafayette $500,000 on July 1 of the current year. The loan is interest-free, payable on demand on December 31. The imputed interest rules are applied. Assume the federal rate is 3% compounded semi-annually. What are the tax consequences of this loan to Lafayette? So this is potentially one of those constructive dividend deals. You're getting a really good deal. You know, an owner, a principal shareholder, is getting a sweetheart deal from the corporation that they control. And so, you know, the IRS is looking at this as, well, are you trying to avoid dividends or avoid compensation and avoid taxes? So we're going to look at the constructive dividend rules and go, well, let's look at this. Okay, so that's kind of the background for it. Now, the rules with advances to shareholders that are not bona fide loans are constructive dividends. So, you know, in this example, we don't know for sure, but we'll at least treat it as if it was a constructive dividend. My answer sheet kind of says there's a whole bunch of rules to look at and so on. We'll just assume for the purpose of our analysis that this is a constructive loan and look at it from that perspective. Okay, so 3%, and the IRS rules say kind of use the federal T-bond rate, and they're going to just say it's 3%. In reality, it's actually a little bit less than that, but we'll just go with the 3% they gave us, obviously. But we would use the federal T-bond rate to compute that, which is essentially what they call the risk-free rate of return. And so take a look at the computation. So if you kind of recall, what I call the PIT method, principal times interest times time, is my PIT method to compute interest. So let's go ahead and do that. So a loan of $500,000 is my principal. My interest is 0.03 times time is half a year, 6 divided by 12. Okay, and I get 7,500. I don't have enough zeros there. 2 more zeros, and I got the right answer. So 500,000 times 0.03 times 6/12, half a year. So that's PIT, principal times interest times time. That's how you compute interest, and we use 6 months because it's semi-annual. Okay, so essentially the answer is $7,500. And then to think about what that is, for Lafayette, that's dividend income of $7,500, which may be offset with the deduction for interest paid to Deerwood, depending on tax status and things like that. Deerwood, the corporation's interest income is $7,500 for the interest received. However, it would not have a deduction for any dividend paid. Okay, so just FYI. Then question 22, and that's where I've got this thing built right here to help us with question 22. Tax consequences to Euclid from the following independent events. Letter A, Euclid buys 500 shares of common stock 5 years ago, so way longer than the 120-day stuff we had to worry about. $50,000. This year they received 20 shares of common stock as a non-taxable stock dividend. What is the basis per share after this event? Okay, so really simple. We'll take the 50,000, and all we have to do is divide it by 520. So they had 500 shares. They had $50,000 that equaled 500 shares. Now they have $50,000 equaling 520 shares. They received 20 extra shares the basis, and this is actually in decimals, 96.15. So it goes from 100 down to 96.15. We're still worth 50,000. So that's the answer to that one. Because we received a like kind stock, we just received more of the same stock. That's why. I have this stock. I have 20 more shares now. Dividend to me. My basis is just now 96.15. In Part B, a little bit different situation. They still own stock, but instead now they receive a preferred stock dividend. So instead of receiving more common stock, they now receive preferred stock. And that would be at 20 shares. And so a little bit different. So we go with the fair market value of the common, which was 50. I'm sorry, it's actually worth 75 now. So in this situation, it's 75. Okay. And the fair market value of the preferred receive is 5. Okay, so 80,000 total. And then our basis changes. So we take the 75,000 fair market value. I can just do it this way. And then I divide that by the 80,000, and I multiply that by my old basis of 50. Okay, and then do the same thing. I take my 5,000, I divide it by the 80,000, I multiply that by my old basis of 50, and I get 50,000 even. Okay, so now my basis is this and this, because in this scenario I received a preferred stock and not additional common stock.